Are stocks on the London AIM market still worth considering? It's been around 23 years and it's been called the most successful growth market in the world. But recently it's had its worst month in close on a decade, and at that time was the worst performing UK market. Can it pick itself up? And if so, is now the time to get back into some of those much beleaguered stocks on the market? Chris Boxall joins us now from Fundamental Asset Management with an overview going into 2019. You manage portfolios for investors. Of course, you're at the front line of this emptying out that we've seen over large parts of the AIM market. How bad is it at the moment?
Well, the returns over the last quarter have been pretty awful. The AIM index is down circa 18% quarter to date. Thankfully, our portfolios are nowhere near as bad as that, even allowing for a Patisserie Holdings debacle, which wasn't good. The Patisserie Holdings almost signalled the massive sell-off, which it started just before. But yeah, as you suggested, AIM's been a huge success, and the difference, the evolution, it's a much better market than it used to be. Just under 1,000 companies, and of those 1,000, much higher quality in terms of real profits, real earnings, real growth potential. You know, we've gone beyond all the highly speculative resource stocks. There are elements of speculation and little bubbles, but generally speaking, there are some really, really good quality businesses generating cash and offering decent dividend yields.
Part of my next question is perhaps maybe being partly answered by this bubble issue. Why have these small caps underperformed? Is it a bubble that's burst, or do you think there are some real reasons as to why some of these stocks have been beaten up?
I think there were pockets of overvaluation, and the problem becomes the overvalued get what you see indiscriminate selling going on, which then attracts others to sell everything. So you're not, and then liquidity dries out. It's typical of AIM. And this morning we saw a company announce, I think the share price fell 5–6% on only £5,000 worth of value. I mean, this is crazy. It was a 60 million circa market cap business. It's not tiny. It's got a broad shareholder base. So all it takes is a few retail sellers, and the price gets hammered. But therein lies often opportunity. The difficulty is you can't even buy. I mean, because the selling's just tiny volume. But yes, in summary, many of the larger companies, the valuations for some looked extremely punchy, and there was nowhere else to go. But you haven't seen massive institutional selling. It's been mostly small numbers of retail sellers that have really pulled things back.
So what have we learned in 2018 to take us through into 2019 as a small cap or AIM investor?
I think from our perspective, we've seen this before several times, and we've learned, in fact, the one thing we have learned is, unfortunately, we've got no other choice because we're managing for inheritance tax planning purposes. We can't do anything. We've got to stay in the market, fully invested. That's pretty awful at times like this. You've got nowhere to hide. However, being there, you're there when it recovers. So patience and doing nothing has rewarded us big time over the years. Going forward, I think people have to be careful to be dragged into so-called value traps. There are some companies that are going to struggle with Brexit and trade war issues. However, there are others, and this is the nature of smaller investing. It's not a macro level. Some of these little companies do very, very well during periods of difficulty. Really good quality businesses often thrive when times get tough, and you've got to really address those. So our first point I mentioned is buy good companies. Don't be trapped, don't be sucked in to the value traps. The things, the share prices have tumbled, they're trading at, looks like very cheap earnings multiples. That can often, flatter. Stick to good businesses. They may look still punchy, the valuations, but their growth profiles, are still intact.
Yeah. What about some of the other issues? I mean, I'm thinking mainly, you mentioned Brexit. Are we talking here about events that are domestically orientated, or are there enough sort of companies that have external facing profit and loss accounts that give us some advantage on the foreign exchange market, for example? Well,
a number of small caps on AIM are very much export-led. We've spoken about some where they're 90% plus of their business is exports. Now, clearly, and not just to the European community, very much, you know, international, great international spread. And many of these businesses have also put measures in place to safeguard them, you know, through a difficult Brexit period. So we think they're in pretty good shape. You know, currency is going to be a big beneficiary for them. You know, cheap sterling makes their services and their products cheaper in an international market. So they could, in fact, do very nicely.
What about balance sheet strength?
We think it's very important to focus, and during times of difficulty, don't get sort of wooed into moving into companies whose valuations are cheap but whose balance sheets are fragile. Stick wherever possible to businesses with decent, you know, levels of cash, decent cash flow, reasonably predictable earnings. Where there is debt, know that the cash flow is reasonably predictable and isn't going to be just cut off. The issue as well is avoid, I would say, one-dimensional businesses that can be impacted by, you know, regulatory change. Just, you know, the business can dry up immediately through one dramatic change. That is an issue with smaller companies. You know, their business models aren't terribly involved. A lot of them, they're very single-line focused. You know, try and invest in those that aren't dependent on any single line of business. One of our other issues is, and I think this has become more and more apparent over the years, you live and learn, is avoid the marketing and the management speak waffle. Yeah. Focus on the numbers, what the business is doing. We believe too much credence is given to meeting management and hearing them wax lyrical about the prospects of their business. I've never heard a bad story from the senior management of a company. I don't think I ever will, even when they're about to go bust. You know, focus on the numbers, look at the sector, what's going on around them, rather than what they're telling you. Investors don't realise that typically the senior management of listed companies are salespeople. They're there to promote the story. They're not at the operating level. They're not actually doing them. They're delegators. You know, their role is to, you know, explain the strategy, but not actually to play it out. So we would urge people to avoid them. Stick to, you know, the reality, the numbers, what they're telling you.
What lessons have we learned from the Patisserie Holdings debacle over the last year?
Well, we have learned, and you know, we have learned, and perhaps we should have been maybe mindful of it. Although this is not alone on AIM and smaller quoted companies, is lack of perhaps management focus. You've got some people at the helm there, one person in particular, who's got multiple interests, and he's not alone. You look through AIM. There are many chairmen, so-called executive chairmen, who appear in numerous companies. Non-executives, there are even more. Now, I do not, in this world where regulation's complicated, where financial reporting's ever more complex, I do not know how these people can effectively do more than one or two jobs. They need to be focused. And it's no accident. Some of the better performers, the senior management, are far more focused and don't have a large number of highly paid non-executiveships. So focus is key. One of our other points in connection with management is director selling and buying. We had pre-sell-off. We had a lot of management selling. Some we've spoken about, which was in my opinion, a little unsavoury. Well, we're also seeing some now buying, and it's noticeable that particularly non-execs, I think you have to assess the quality of the buying and the selling. I think we take more, we store by executive management buying rather than non-execs. Great to see everybody buying, but you know, we would definitely, there's more, you know, a whole more store in executives buying rather than non-execs. Just
a couple more very brief points.
I think AIM itself, we're desperate for new companies. I mean, it's been an awful period for newcomers on AIM. Very few IPOs, so we want to see some really good quality IPOs coming on the market. Clearly, it's not a terribly encouraging environment when the market's just fallen a lot, and with fewer and fewer corporate brokers, it could be tough to attract newcomers, but we desperately need them.
Yeah. And finally?
Finally, takeaway, we say invest in what you know. Stick to things you know about. Some of them will have fallen a lot. Invest in what you know and know what you invest in.
Look, Chris, we've got to leave it there, but thanks for joining us. That's Chris Boxall from Fundamental Asset Management.